Your money-making broadcast starts now. Good evening. Today is June 4th, Thursday. Broadcom just crashed 12% on record earnings, and the S&P 500 didn't even blink. That's not a glitch. That's a regime shift. The rotation from growth to value is happening in real time, and tomorrow Kevin Warsh takes the helm of the Federal Reserve. This isn't just a leadership change, it's a potential paradigm shift in how the market values cash flows versus hype. We'll break down exactly what this means for your portfolio and why capital preservation is the new offensive strategy. Before we dive into the big stories, let's look at the closing numbers. The S&P 500 finished at 7,584, up 0.41%. The Nasdaq ended at 26,831, down slightly by 0.09%. The Dow Jones Industrial Average saw a significant jump, closing at 51,562, up 1.73%. In the ETF space, SPY closed at $757.09, QQQ at $740.61, and DIA at $516.70. The Russell 2000, tracked by IWM, rose 1.51% to $292.01, confirming that small caps and value stocks are currently the preferred destination for capital. The VIX dropped 4.11% to 15.40, suggesting that the pre-market fear has subsided. In commodities, gold rose 1.25% to approximately $4,494, as safe haven demand persists. Bitcoin and oil remain in a tight consolidation phase as the market waits for the Fed's new direction. This divergence between the Dow and Nasdaq is a critical signal. It suggests that the everything rally is fracturing into a more selective, quality-focused market. From a Java's perspective, this indicates a transition from a momentum-driven market to a fundamental-driven market, where the quality of earnings is scrutinized more heavily than the sheer speed of growth. Our first and most critical story today is the Broadcom shockwave. Broadcom, trading under the ticker Broadcom, plummeted 12.59% in a single session, closing at $418.91. On the surface, the numbers looked like a victory. Broadcom reported record Q2 FY26 revenue of $22.2 billion, a staggering 48% increase year-over-year, with AI-driven semiconductor revenue exploding by 143%. They even raised their full-year guidance to $56 billion, which is a 180% increase. So why the crash? The market is obsessing over gross margin mix. Investors are worried that the rapid scale of AI integration is eating into the quality of their margins. Specifically, the cost of scaling custom AI accelerators may be higher than previously modeled, leading to a compression in net profitability despite the top-line growth. However, Java's analysis suggests this is a company-specific event rather than a systemic sector collapse. We know this because other AI leaders actually rose today, proving that the AI demand story remains intact. The divergence between Broadcom and the rest of the sector indicates that the market is now distinguishing between AI growth and AI profitability. Interestingly, legendary investor Stanley Druckenmiller reportedly exited his position at $487.12, locking in a 12.4% gain. For the retail investor, this is a lesson in the danger of perfect expectations. When a company beats on revenue but misses on a specific margin nuance, the volatility is brutal. Javas is currently placing Broadcom on a watch list, suggesting a potential re-entry point around $400, but only after we see the initial reaction to the new Fed leadership tomorrow. We must monitor the 200-day moving average to ensure the long-term trend hasn't shifted to bearish. If the stock fails to hold the $400 level, we could see a further slide toward the $370 support zone, which would signal a deeper structural issue with their AI pricing power. Moving to our second big story, we see a fascinating divergence in the tech space with Alphabet's rebound. The stock climbed 3.68% today, closing at $372.19. This rally is fueled by a powerful combination of technicals and institutional backing. From a technical standpoint, the Relative Strength Index or RSI had dropped to 27, signaling a deep oversold condition that practically begged for a bounce. But the real catalyst is the Berkshire effect. While the broader market was panicking over a potential $85 billion dilution concern, Warren Buffett's Berkshire Hathaway stepped in with an additional $10 billion investment. This sends a clear signal to the street: the long-term value of Google's AI moat outweighs short-term accounting noise. Howard Marks has pointed out that the most profitable trades happen when the crowd is focused on the wrong risk. By ignoring the dilution fear and focusing on the core asset, Berkshire has provided a floor for the stock. This institutional support acts as a psychological barrier for other funds to enter. For those holding the stock, the momentum is shifting back to the bulls, and Javas identifies $350 as the critical support level for any future accumulation. We believe the integration of Gemini into the core search ecosystem is finally showing a positive ROI, which will be the primary driver for the next quarter. We are seeing a gradual shift in how the market perceives the search to AI transition, moving from a fear of disruption to an appreciation of ecosystem dominance. This is a classic example of how institutional smart money can stabilize a stock during a period of retail panic. Finally, let's look at the macro landscape and the looming Warsh Fed era. Tomorrow is D-Day. Kevin Warsh officially takes over as Fed chair. The market has already begun pricing in his arrival, and we are seeing a textbook rotation. The Dow Jones Industrial Average surged 1.73% today to 51,562, while the Nasdaq remained nearly flat at 26,831. This is a clear signal that investors are moving from high-growth, rate-sensitive tech into value and financial sectors. We saw JP Morgan Chase jump 3.34% as traders anticipate improved net interest margins under Warsh's leadership. The central question for tomorrow's first address is whether he will be gradual or aggressive in his approach to inflation and interest rates. If he signals a gradual approach, the S&P 500 could easily push towards 7,650. However, an aggressive tone could trigger a sharp correction in the tech-heavy Nasdaq. We are currently in day 43 of a bull market, which is right in the historical danger zone of 42 to 49 days. This window is often characterized by a blow-off top or a sharp reversal as early buyers begin to take profits. With the VIX dropping to 15.40, the market is deceptively calm, but the underlying tension regarding the Fed's new direction is palpable. The options market is currently pricing in a high implied move for tomorrow, suggesting that the Warsh effect will be the primary volatility driver for the rest of the month. This is a high-stakes environment where a single word choice in the Fed chair's speech could swing trillions of dollars in market capitalization between growth and value sectors. On the macro front, the yield curve steepening we saw today is another confirmation of the value rotation thesis. Financial stocks like JP Morgan gaining 3.34% on NIM improvement expectations is a classic pre-Warsh positioning trade. If the new Fed chair signals a gradual normalization path, this rotation could accelerate significantly. We are seeing a shift in capital from the Magnificent Seven toward the Industrial Seven, where companies with tangible assets and strong cash flows are being revalued. This is not just a temporary dip in tech, but a structural realignment of the portfolio. Investors are now prioritizing dividend yield and PE ratios over speculative future growth. This shift is further evidenced by the rise in gold to $4,494, as investors hedge against the possibility that Warsh might be more hawkish than the market currently expects. The interplay between the 10-year Treasury yield and the S&P 500's forward PE ratio will be the most important chart to watch over the next 72 hours. Java's analysis indicates that if the 10-year yield pushes past 4.5%, the current valuation of the Nasdaq becomes unsustainable, necessitating a further 5 to 10% correction to align with historical norms. Conversely, a stabilization of yields around 4% would provide the necessary breathing room for a renewed tech rally. We are essentially waiting for the Warsh signal to determine if we should be overweight in value or start accumulating growth assets again. To wrap up today's session, we've witnessed a market that is remarkably resilient in the face of individual stock crashes, but deeply anxious about the macro pivot. The rotation from growth to value is no longer a theory, it is happening in real time as the Dow hits new heights while the Nasdaq struggles. Now, let's look at the Java's recommended lineup for the coming days. First, for a safe-type play, the world's greatest global diversification expert, John Templeton, would favor Canadian Pacific Kansas City, CP.TO, at $124.37. This is a low-volatility defensive play with a current gain of 10.37%. We recommend holding and looking to expand the position if it dips to $122. For a balanced-type approach, the legendary growth stock hunter, Phil Fisher, would point toward a diversified enterprise tech leader with strong AI adoption and consistent cash flow. This offers a blend of safety and upside. The strategy here is to hold, with a buy trigger following the Warsh transition. For those seeking a growth-type opportunity, the world's leading innovation fund manager, Cathie Wood, would look at the AI infrastructure theme. AI networking and data center demand continue to accelerate. We are watching for a consolidation phase before increasing the position. Finally, for a low-cost, value-oriented play, the father of modern value investing, Benjamin Graham, would look at Cisco Systems (CSCO) at $130. With a massive 35.86% profit already locked in, this is a play on AI networking infrastructure at a reasonable valuation. We recommend holding the remaining position as a core stability asset. Looking ahead to next week, keep your calendars marked for the post-Warsh volatility. We expect the S&P 500 to oscillate between 7,500 and 7,650 depending on the Fed's tone. Watch the $185 level for CRM and $415 for AMD, If these break, the risk management protocol dictates an immediate exit. Looking at the broader context, we are on bull market day 43, approaching the historical average duration of 42 to 49 days. The VIX has eased to 15.40, down 4.11%, suggesting the pre-market panic over Broadcom has subsided. Gold continues its safe haven rally at $4,494 per ounce, up 1.25%. Our portfolio stands at $107,661 with a massive 82.8% cash position, providing ample firepower for the post-Warsh market regime. The key levels to watch tomorrow are CRM at $185 and AMD at $415. If these support levels break, our risk management protocol dictates an immediate exit. Next week brings the first full trading week under Chair Warsh, with the S&P 500 expected to trade in a 7,500 to 7,650 range depending on his opening tone. One more critical point for tomorrow, the VIX structure tells us volatility expectations are elevated heading into the Warsh announcement. Pre-market fear was at 16.54 before settling to 15.40 at the close. That 6.9% intraday drop in the VIX itself signals the market is positioning for a specific outcome. If Warsh sounds gradual, we could see a relief rally taking the S&P 500 towards 7,650. If he leans aggressive, the VIX could spike back above 18, and the 7,500 level becomes the critical battle line. Our 82.8% cash position gives us the luxury of waiting for that signal. Remember the Druckenmiller playbook: lock in gains when expectations are euphoric, build cash when uncertainty peaks, and deploy when the fog clears. That is exactly the strategy we are executing today. Patience is our greatest asset right now. Let the Fed speak first, then deploy capital. We will be monitoring the 2-year and 10-year yield spreads in real time to detect any sudden shifts in recession probability or inflation expectations. Subscribe to stay ahead of the markets every single day. We break down the data so you don't have to. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.